Hey Gen Z future CPAs, welcome. If you're aiming to absolutely crush the boards and get that CPA title, you're in exactly the right place. Today's explainer is your ultimate survival guide to the Philippine VAT zero rating rules under the Create and Create More Acts. We're going to lock this knowledge into your brain so tightly that you'll easily retain it for the next 3 years, straight into your luck pat test day. No fluff here, just the high-yield tax concepts you actually need to survive and thrive. Okay, let's dive right in. Here's our roadmap for today's explainer. 1. VAT zero rating essentials. 2. Title 13 incentives explained. 3. The directly attributable upgrade. 4. The 70% EOE rule. 5. Disqualifications and IPA certs. And 6. LEGPA bullet review hacks.
Section 1. VAT Zero Rating Essentials.
Right, before we can even talk about the new laws or special economic zones, we need to solidify the absolute foundation. VAT zero rating is a transaction where your output VAT is exactly 0%. But, and this is the absolute magic part, you're still entitled to claim the input VAT on your purchases as a tax credit or a refund. For the board exam, you cannot confuse this with being VAT exempt. When you're VAT exempt, you don't get to claim input taxes. Zero rating is infinitely better for a business, because while you charge 0% on your sales, you actually get to keep or refund the input taxes you paid. It's a total win.
Section 2. Title 13 Incentives Explained. Let's look at how Title 13 of the Tax Code leverages this zero rating concept for special entities. Now you're going to see this alphabet soup all over your review materials. RBEs are registered business enterprises. Under that massive umbrella, we have REEs, which are registered export enterprises, and high-value DMEs, meaning domestic market enterprises. These entities operate inside special zones, and under Title 13, they enjoy a truly massive privilege. And here is that core privilege. Local purchases of goods and services by these qualified entities are subject to 0% VAT. So the absolute crucial takeaway for your exam is this. Local suppliers in the Philippines do not pass on that standard 12% VAT to these qualified enterprises. It completely preserves the working capital of the enterprises and heavily incentivizes them to keep doing business here in the country.
Section 3. The directly attributable upgrade. Grab your highlighters because we're entering prime LECPA testing territory here with the Create More Act. Notice the stark contrast on this one. Our brains love contrasts to build that long-term memory, right? So the old rule prior to Create More was incredibly strict. To get the zero rating, a purchase had to be for direct and exclusive use, meaning it was strictly necessary for the registered project. But look at the upgrade. The Create More Act changed this to directly attributable. This broadens the scope massively. It now includes goods and services that are merely incidental to and reasonably necessary for the registered project.
To help you instantly recall this shift, I call this the janitor and HR rule. Seriously, burn this list into your memory. Under this new directly attributable standard, zero rating now explicitly covers those incidental administrative operations. So if a board exam problem tries to trick you by asking if an RE's legal fees, human resources, accounting, or even their janitorial and security services qualify for the 0% VAT under Create More, the answer is a resounding yes. They're now legally considered directly attributable. Section 4. The 70% EOE rule. Okay, let's pivot slightly to export-oriented enterprises, or EOEs, and the magic threshold that dictates their entire tax life, 70%. If you literally only remember one number from this entire explainer, make this one. This is the golden threshold an enterprise has to maintain to qualify as an export-oriented enterprise. Here's the exact checklist you need to memorize. To score that 0% VAT on their local purchases, an EOE must hit export sales of at least 70% of their total annual production. But here's the key detail examiners love to test. It's based on the immediately preceding taxable year. And just like the RBEs we talked about a minute ago, their purchases must be directly attributable to that export activity. Finally, who's actually checking all this? The Export Marketing Bureau of the DTI is the agency calling the shots on compliance with this 70% threshold. Section 5. Disqualifications and IPA asserts. But what happens in the real world, and more importantly on the board exam, when things go wrong? Let's anticipate exactly how the examiner is going to try to trick you here. Imagine you're sitting for the LECPA and you read a scenario where an EOE had export sales amounting to exactly 69% of their total annual production last year. They missed the mark by literally 1%. What's the tax consequence? Your alarm bells should be ringing right now. The answer is total disqualification. The law is strictly applied here. If they fall below 70% in the preceding year, the enterprise completely loses its VAT zero rating privilege on local purchases in the immediately succeeding year. That means their local purchases will suddenly get slapped with a standard 12% VAT. Examiners absolutely love to test the consequences of falling short, so keep that phrase, immediately succeeding year, locked in your mental framework. Now, assuming they do qualify, how do they actually claim it on paper? There are some bureaucratic hoops. RBEs have to annually apply for a VAT zero rating certificate from their specific investment promotion agency, or IPA, like PISA or BOI. They then take the certificate and present it directly to their local supplier. And here is a fantastic update to streamline doing business. Local suppliers no longer need to apply for approval of that zero rating with the BAR. Just handing the IPA certificate to the supplier is totally sufficient. Section 6, LECPA Bullet Review Hacks. We've covered a ton of ground, so let's lock in this 3-year memory retention with a rapid-fire review of exactly what you need to look for on test day. Take a mental screenshot of these concepts. Part 1. First, if a problem says 0 rating, instantly trigger the thought 0% output, but the input is claimable. Second, Title 13 entities get 0% on local purchases to save working capital. Third, if you see the term EOE, immediately scan that problem for the number 70. They need 70% export of total annual production. And fourth, always verify the timeline. That 70% is assessed based on the immediately preceding taxable year. Moving right along to part 2 of our hacks. If the exam mentions the Create More Act, aggressively eliminate any multiple choice options that say direct and exclusive. The new rule is directly attributable. Use that janitor and HR rule hook to remember that incidental admin costs are perfectly valid for 0 rating now. Watch out for the 69% trap. Falling even a tiny bit short means disqualification for the very next year. And finally, remember the paperwork flow. An annual IPA certificate from PESA or BOI goes straight to the supplier, completely bypassing the BIR approval step. You now have the exact mental framework, the visual chunks, and the specific study hacks to absolutely dominate this topic. But here's a thought to leave you with. As global markets continue to shift, do you think that 70% export threshold will be enough to keep the Philippines competitive? Or will lawmakers eventually be forced to lower it to keep these enterprises here? Keep questioning the why behind the tax code like that, and you'll effortlessly pull this info out of your brain on exam day. Thanks for learning with me today, and keep that focus sharp.